Welcome to Shet Vidya Mandir online lessons. Let's do another sum on admission of partner. Vaibhav and Vilas are partners sharing profits and losses in the ratio of 2:3. Their balance sheet is given to us as on 31st March 2012. So all the same items of balance sheet, capital, creditors, all the assets, cash. They have agreed to admit Vivek as a partner. So the new incoming partner is Vivek. And the following terms have been agreed upon. He is going to bring 1/4 share in future capital he is going to receive. And he is going to get 25,000 as his capital and 20,000 for his share of goodwill. Land and building is valued at 30,000 and stock is valued at 55. So let us mark land and building and let us mark our stock. Plant is taken over by Vilas at 10% discount. See Vilas, plant is taken over. Mark your plant account. Depreciate furniture by 10%. Mark your furniture as well. Provision for bad and doubtful debts is to be maintained at 5% on debtors. So mark your debtors, you have to reduce 5% as RDD. Now this last point is very important. The capital account of all partners is to be adjusted in their new profit sharing ratio and the excess amount is to be transferred to their loan account. So you have to find out the balance and it has to be adjusted in the new profit sharing ratio and the excess amount has to be transferred to the loan account. This I will explain to you. Now let us start. Now see, let us find out the new profit sharing ratio. The old ratio is given to us as 2:3. That means Vaibhav is getting 2/5 share and Vilas is getting 3/5 share. Okay. And what they're saying, the new partner Vivek is going to get 1/4 share in profit. Okay. Now let us assume, we are assuming that profit of the firm is 1. Okay. And how much is the new partner getting? Vilas, he is going to get 1/4, 1/4. So what is the balance that the other partners are going to get? 1 minus 1/4. That is 3/4. Is this clear? See, suppose this is the profit of the firm. Okay. 1/4 is taken over by the new partner, Vilas. So how much profit is remaining? This is 3/4. Out of 3/4, the old partners, Vaibhav and Vilas, have to share in the proportion of 2:3. So how will we find out? We have to find out, let's see Vaibhav's share. Vaibhav's ratio will be 3/4, this 3/4 into 2/5. That is equal to 6/20. And the other partner is Vilas. So Vilas' share is 3/4 into 3/5 is equal to 9/20. And the third one we know, Vivek, his share is 1/4 anyway. Now denominator I want as 20, so I multiply by 5. That is 5/20. So what is my new profit sharing ratio? 6:9:5. Okay, this part is important. Now they are telling us in the sum that he is getting 25,000 as capital and 20,000 as goodwill. Let us see what we are going to do for that. Cash account debit to Vivek capital is how much? 25,000. I am telling you the journal entries. We shall see in the ledger soon. And as goodwill, what he is getting, that will be cash account debit to goodwill account. How much was that? 20,000. Okay. And now this goodwill will be distributed among the old partners. So you will write goodwill account debit to Vaibhav and to Vilas. This is 20. Now old profit sharing ratio was how much? 2:3. So in that proportion these two will settle it. Okay. this will be 8, and this will be 12. Alright. Now let us see that last entry. The capital account of all partners is to be adjusted in the new profit sharing ratio and the excess amount to be transferred to loan account. So what should be the new capital of the partners? So for that, this new profit ratio is required. This is required for that calculation, for that last entry. So how we are going to do that? See. Now this new partner, what is his name? Vivek. He is going to get 1/4 share. Okay. Now 1/4 share he is getting, and what is the capital that he is getting? 25,000. So for 1/4 share he is getting 25,000 capital. So what should be the total capital of the firm? That will be 25,000 into reciprocal of this. What is meaning of reciprocal? 4 goes up and 1 comes down. Reciprocal of 1/4. So that is 25,000 into 4. That is equal to 1 lakh rupees. So your total capital has become 1 lakh rupees. Now that 1 lakh has to be divided into that new profit sharing ratio, 6:9:5. Did you understand? So you will write Vaibhav, that is the first partner. Vaibhav's capital will be how much? 1 lakh into 6/20. Okay, how much is that? 30,000. And the other person, Vilas, what is his capital? 1 lakh into his profit sharing ratio is 9/20. So that is 45,000. So your capital should be shown as 30,000, 45,000, and that third partner, the new partner's capital is 25,000. So these are the new capitals that will reflect in the balance sheet, and any excess or deficit in the capital account will be transferred to loan account. That is what that last entry is all about. Now let's start solving. These are the accounts: revaluation account, partners capital account, and we have here the balance sheet of the new firm after the admission of partner. So let's start first with the asset side. Okay, so we have land and building. Land and building right here in the asset side. Land and building. I write in the inner column because marking is there. So write here 25,000. Leave a line. Write here plant. Plant is taken over by the old partner. So inner column again 30,000. Now leave 2 lines because there are 2 adjustments here. Then go to furniture. Again there is adjustment in furniture, 2,000. Inner column. Then we have stock. Again adjustment in stock, 50,000. Debtors, 58,000. This is all from the previous balance sheet. And cash, we will write this later because he has got in cash as goodwill and as his capital. So we'll do this part later. Here let us write down capital account. Write the names: Vaibhav, Vilas, and the new guy is Vivek. Then leave a line, write creditors. Do we have any adjustments? No. So directly outer column 70,000. Okay. Now what else is left? Capital account. Let's take it there. By balance brought down. Both is 50,000. Balance brought down. Okay. Now this new person Vivek is getting, how much he is getting? 25,000 cash. So we will write buy cash. Vivek column we will write 25,000. And goodwill is to be distributed. He has got goodwill 20,000. Now it is to be distributed among old partners. So you will write here buy goodwill 8,000 and 12,000. Okay, that is the first adjustment. Next is land and building is valued at 30,000. Land and building earlier value was 25,000 and now it is 30,000. That means there is appreciation. So write here appreciation 5,000. So outer column will be 30,000. And this appreciation second effect will go to revaluation account. Remember, nominal account, debit all expenses and losses, credit all incomes and gains. So now the value has increased, you have gain. So you will write here buy land and building 5,000. Next, after that we have stock is valued at 55,000. What is the initial value of stock? 50,000. This is now become 55,000. So again it has increased. Less appreciation 5,000, because the outer column is 55,000. So 55,000 minus 50. So appreciation you know is 5,000. Second effect again we will write here buy stock 5,000. Okay. Plant is taken over by Vilas at 10% discount. See what is the value of plant? 30,000. Less 10% discount. So 3,000 has to be reduced. So the value is 27,000. Okay. Now this is taken over by Vilas, 27,000. So here now there is no plant remaining in the firm. So now there will be two effects here. This 3,000 will go to revaluation account and this 27,000 will go to partners Vilas capital account. So write here to plant 3,000 and the other effect is in partners capital account to plant account Vilas 27,000. Okay. Now depreciate furniture by 10%. Less 10% depreciation. So 200. So here it is 1,800. Second effect, revaluation account to furniture, that is 200. What else is remaining? Provision for bad debts is to be maintained at 5% on debtors. Less RDD 5%. Now 5% is how much? 2,900. So outer column is 55,100. And the second effect to RDD, this is your liability RDD. So here it is 2,900. Okay. The capital account of all partners is to be adjusted in the new profit sharing ratio. This I explained to you earlier, in the new profit sharing ratio. So what I will do is, I will write here to balance brought down. Okay. We had already calculated, remember, see here, we have calculated Vaibhav's capital is 30,000. Vilas capital is 45,000 and the new partner's capital is 25,000. So this we will write in the balance carried down. So write here 30,000, 45,000 and 25,000. Okay. Now let us see the cash also. Cash, earlier in the balance sheet, cash was given to us as 5,000 in the opening balance sheet, and how much has been added? capital got by the new partner was 20,000, 25,000, and he got in goodwill that he got 20,000. So what is my total capital? 50,000, sorry, total cash. Total cash that I have right now in my firm is 50,000. So I will write down here 50,000. Okay. I think we are done with all. Now let's start revaluation account. Let's find out the profit or loss on revaluation. This side is 10,000 and here profit is 3,900. To partners capital account. So only the old partners are going to get now, Vaibhav and Vilas. In their profit sharing ratio, 3,900 is the profit on revaluation. Now distribute this in the proportion of 2:3. So you will get 1,560 and 2,340. Okay. The second effect of this, partners capital account by revaluation account, 1,560 and 2,340. Let us find the answer. Now whatever deficit or surplus is there, that has to go to loan account. So instead of balance carried down, we will take it to loan account. So let us balance. This person Vivek, both sides is 25, the new partner. Okay. Now the other partner, here it is 30,000, here it is 59,560, 59,560 minus 30,000. So you will write here to loan account is 29,560. Here total is 59,560. Now see the other person Vilas. Vilas, this side is more. Here it is 72,000 and this is less. So whatever is the deficit, it will also go to loan account. This will go on the asset side and this loan account here will go to the liability side. So here you will write 72,000 and here you will write 7,660. Now we have to, what will take to the balance sheet? These three figures will go to the balance sheet and also this and this will go to the balance sheet. Let's transfer them. Capital here write down 30,000, 45,000 and 25,000. Okay. So here this is 1 lakh. And loan account, loan from Vaibhav. Is how much? 29,560. And here also loan to second partner was Vilas. How much was that? 7,660. So find out the balance both the sides. Here it is 199,500. Okay, 1,99,500, and here also it is the same 1,99,500. So what was different in this sum from the earlier problems? That last adjustment, that capital account had to be adjusted in the new profit sharing ratio and excess or deficit was to be transferred to loan account. So you practice this problem once again, okay students, because it's very important from exam point of view. Take care. Thank you.